Welcome back to the Capital Breakdown, where we make sense of money, markets, and investing with clear, steady steps. Today we're tackling a question that might surprise you. Are bond ETFs just boring leftovers in a portfolio, or could they actually be the missing puzzle piece to balance out your stock-heavy investments? By the end of this episode, you'll understand how bond ETFs work, why they matter, and how they can fit into your bigger investing picture without the fluff or hype. So let's break down the role of bonds in a world that seems obsessed with stocks. Here's the problem. Many investors see bonds, and especially bond ETFs, as dull or outdated, especially when the stock market is booming. It's like choosing plain toast when you could have loaded breakfast sandwich. But just like that simple toast can be the steady foundation for a meal, bonds can provide stability that stocks alone often can't. People often overlook bonds because they focus on chasing high returns from stocks, not realizing that without some steady income or protection, their portfolio can feel like a roller coaster with sharp drops. So, how do we make sense of bonds in a way that feels relevant and practical? That's what we're about to explore. Think of your portfolio like a garden with different types of plants. Stocks are the fast-growing, colorful flowers that can bloom quickly, but sometimes wither in storms. Bonds, on the other hand, are like the sturdy shrubs. They might not catch your eye as much, but they help hold the soil in place and keep the garden stable when the weather turns rough. Bond ETFs are baskets of bonds bundled together and traded like stocks. They allow you to own a slice of many different bonds without having to buy each one individually. Bonds themselves are essentially loans you give to governments or companies, and in return, they pay you interest over time. This steady income and relative stability is why they're called fixed income investments. Let's take that garden analogy a step further. Imagine you're watering your garden regularly. Stocks might need more attention because they grow fast and can be unpredictable, like watering flowers during a heat wave. They could either flourish or wilt quickly. Bonds, through bond ETFs, are like those shrubs that need less fuss and help keep your garden looking balanced overall. When stocks drop because of market storms, bonds often don't fall as much or might even rise, helping reduce your overall risk. This balancing act is called diversification, and it's a fundamental principle behind building a resilient portfolio. So what's actually going on behind the scenes with bond ETFs? When you buy a bond ETF, your money goes to a fund provider who pools cash from many investors to buy a variety of bonds. These bonds can be issued by governments, big companies, or municipalities. The fund manager handles all the buying, selling, and collecting interest payments. When bonds in the fund pay interest, that income flows through to you as an investor, usually in the form of regular distributions. Brokers are the middlemen who execute your buy or sell orders on the exchange, and regulators keep the whole system transparent and fair. Of course, there are fees involved, usually a small annual expense ratio that covers management costs, but these fees tend to be lower than actively managed funds, making bond ETFs a cost-efficient way to access fixed income. Now let's illustrate how this plays out with real lifestyle examples. Imagine someone named Alex who invests a fixed amount every month into a broad stock ETF, say one that tracks a large market index. Over time, Alex enjoys growth with the ups and downs of the market, but during downturns, the portfolio's value can drop sharply, causing stress. Now, imagine if Alex also adds a bond ETF to the mix. When stocks dip, the bond ETFs often soften the blow because bonds tend to react differently to economic changes. This combination can help Alex stay on track without panicking and selling at the worst time. On the flip side, consider Jamie, who puts all their money into a single speculative stock, chasing quick gains. That's a much riskier path, with potential big losses if the company struggles, showing why diversification across asset types can be a safer strategy. It's important to know the risks too. Bonds aren't risk-free. Interest rates, inflation, and credit quality all affect bond prices. For example, if interest rates rise, bond prices generally fall, which can impact bond ETFs. Also, if you concentrate too much in one type of bond or sector, you might face unexpected risks. And unlike stocks, bonds don't usually offer the same chance for rapid growth. So your time horizon and goals matter. Trying to time the market or chase yield without understanding these factors can lead to frustration or losses. Patience and realistic expectations are key. Bonds are more about steady income and stability than explosive growth. So, how should you think about bond ETFs in your broader financial life? First, make sure your budgeting and emergency fund are solid. This is your foundation. Then, consider your goals. Are you investing for long-term growth, income, or preservation of capital? Bond ETFs can play different roles depending on your stage in life. Younger investors might use them to add some stability without sacrificing too much growth, while those closer to retirement might lean more heavily on bonds to protect against market swings. Remember, this isn't a one-size-fits-all prescription, but a tool you can use thoughtfully alongside stocks, savings, and other investments to build a portfolio that fits your unique situation. To wrap things up, here are the 3 big takeaways from today's episode on bond ETFs. First, bonds and bond ETFs are not just boring. They're a foundational part of a diversified portfolio that can help reduce risk and smooth out volatility. Second, bond ETFs work by pooling many bonds together, offering you easy access to fixed income with professional management and relatively low costs. And third, like any investment, bond ETFs come with risks and require patience, realistic expectations, and a clear understanding of your goals and time horizon. Always do your own research and consider talking to a qualified financial professional to ensure your choices align with your personal situation. Thanks for tuning in to the Capital Breakdown, where we cut through the noise and help you feel confident about your money. Until next time, keep learning, stay steady, and keep building that financial future step by step. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.